Welcome to today's episode of the Michael Yardney podcast and today's question and answer day. In other words, we're going to answer the topics that you, our listeners, have asked. And I'm going to be joined by Ken Race, Director of Metropole Wealth Advisory. I'm going to pose 4 questions to Ken, and I know he's going to be sharing some advanced strategies. And that should be valuable for you wherever you are in your property journey. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Today I'm joined by Ken Race, Director of Metropole Wealth Advisory, to answer a number of your property questions. Now, Ken's widely regarded as Australia's leading property tax and structuring specialist, and he's the co-author of the latest edition of What Every Property Investor Needs to Know About Finance, Tax and the Law. Hi, Ken.
Hi, Michael.
Now, Ken, we regularly get heap of questions left on Property Update and on our social media about all sorts of matters related to property, tax and finance. So today I've selected a number that I think are right down your alley. So Ken, let's start with a question sent in by Rob. And Rob said, I currently own a number of investment properties, but I'm keen to transition from just a buy and hold strategy to something more active like renovations or property development. So his question to you, Ken, is what do I have to watch out for? Are there any tax implications I should be aware of?
Yes, a potential minefield. So
I'd like to talk about the tax and the finance ones, and then maybe I'll mention a couple of things about development, because there's people out there saying, oh, it's so easy to buy properties, renovate and flip, buy properties, develop and sell. It doesn't work as easily as that, does it, Ken?
it certainly doesn't. And it's the tax that normally kills people and the time delays. So good question, Rob. So let me start maybe by saying generally the purchase and sale of an existing residential property is what they call input taxed. And as such, you don't apply GST when you sell it, but then you can't claim any of the input tax credits on the goods and services that you've bought to do that development or renovation. The other thing you've got to be very careful about is what was your intention when you purchased. That's critical. That's when the ATO gets into your brain and can, through a series of questions, work out why you did it. So if the sale of the asset purchased was with the intention to keep, that attracts the general 50% general discount if you kept it more than 12 months. But if you purchased it with the intention to sell, you lose the 50% discount and the profits are taxed at just your normal marginal tax rates.
Now, Ken, maybe we should preface it by saying Rob sent us this question. We don't know if his intention is to do this to hold on to in the long term or to trade. And I think what you're hinting at here at the start of the conversation is you're wondering whether he's doing this to flip and trade and make a profit, which is what a lot of people come to us with initially the intention to do, because they're buoyed by some of the websites and some of the blogs and some of the things on Instagram. But I think where we're going to end up saying is that's maybe not the best way to add value.
Yeah. And certainly it becomes a minefield if you are buying to sell, because the other thing you've got to do is you've got to consider that you're considered to be in business. If your intention is to buy, develop and sell, then you're in business and you've got to register for GST. And even if this is your very first transaction, because that's your intention, you could still be in business. So you've got to be careful of all the normal business issues. You've got to do your feasibility study. You've got to take into account all your costs, including stamp duty, land tax, to determining your profitability. And if it's an existing property, then there's no GST because you didn't have to register for GST if your intention was to keep. But if it was to sell, you must have registered for GST. And that's critical. A lot of people don't register for GST, and when they get caught, there are heavy, heavy penalties. But can I say there's one benefit if you're going to buy with the intention to sell, you can now claim the interest expense and the holding costs during a construction period, which you're not allowed to do if you've bought it with the intention to build and develop to keep.
Now, a lot of people don't realise that, Ken. So they'll buy a house and then they'll maybe have it for a year, get some rent from tenants, and then it becomes vacant and they pull it down and they construct. There's an interest cost, isn't there? But,
correct.
It's not a tax deductible interest cost. It becomes part of the capital base. Is that correct?
Correct, which reduces the profit when you sell. And that's the same as your rates and taxes, water, council, all those things added to the cost base. Whereas you can claim them along the way if your intention was to sell. The other thing, if you're looking at selling, consider margin scheme. Now, that's probably way too big a topic to discuss on this podcast, because that in itself could take half an hour. So look at margin scheme. And what a lot of people do is they have mixed intentions. They might say, let's build and we'll sell some and we'll keep some. So you can do that and have the different tax treatments, and you then apportion your GST and you treat the profits on the ones you decided to keep versus the one you decide to sell differently. So that can be very, very important. And if, as the question suggests, you might be doing this with friends or relatives, then sometimes we find that while one person can't fund a whole development of, say, two, they can individually fund their own. And then the problem comes, what happens at the end when I try and split?
Now, most people don't realise that, Ken. So let's just go back a step. Either Rob's going to buy a property and renovate it, and that's a bit different, and we've spoken a bit about that before. That's a good way of manufacturing some capital growth, but there's never enough margin unless you're doing a structural renovation, adding a large part to make enough money to flip it. But to actually renovate and add value and then get better rent and depreciation allowance, that makes sense. And we similarly believe it's a good idea for some people, once you've already been a buy and hold investor for a while, to consider the concept of property development, manufacturing your own capital growth. And we like that because at the end you end up with some modern dwellings, often townhouses that are big modern accommodation on more compact lots. You get higher rental returns because the tenant's paying you the full rental, even though you've been the developer, so you bought it at wholesale. But it's not as simple as that. There's lots of costs along the way. It takes quite some time. We've done a project development podcast before with Bryce Yardney, and I'll probably get him on and we'll do another one. So you've got to first understand what you're planning to do. But some people say, I actually can't do it on my own. I'll do it with my uncle, my brother, my friend. The trouble is you buy the property in both names, and then when you complete them, you've actually got both names or entities on both titles. So if it's you and me, Ken, I'm going to sell half of unit 1 to you, and you've got to sell half of unit 2 to me. But that means I've got to pay GST, stamp duty, capital gains tax. There's lots of tax implications of splitting the joint venture that people don't even know they're getting themselves into.
That's right. And they're not insignificant because, that can account for about 18 to 20% of the end value. So all the profit you made by going through all that development, you lose.
Is there a way around it, Ken?
Absolutely. Absolutely.
It was a loaded question. I know there is, because a lot of our clients get involved in property development. We're probably involved in, I think it's over 55 projects for clients in Melbourne and Brisbane at the moment, helping them develop. And it's a common question they ask, but they've got to ask it, and they've got to get their structures and any arrangements correct.
Structures are critical.
Before they even start, Ken. Is that
correct?
A fair comment?
Structures are critical, and you've got to get the right structure because that can have a massive difference to your tax bill, to your asset protection, to your flexibility. So you've got to consider different structures. And if you've got mixed intentions, I'm going to keep some, I'm going to sell some, if you're developing, then you might have multiple structures. And don't be afraid of, I'm going to have two trusts or I'm going to have a company. Just think of the end in mind. There's, a pot at the end of the rainbow. There's going to be money there, hopefully. So get the right structure to maximize what you're trying to do.
Well, it's a cost of doing business, isn't it?
Absolutely correct. And if you're in business to develop to sell, then it's even tax deductible. you did ask that question if people are buying together. And I don't know if you want to answer that now or
Why not?
Because you'd asked me a big question on joint ventures a bit later on.
Let's leave it for that because you actually read ahead of me and what some of the other questions are. So we can do that. So my advice to Rob is, yes, I think it's a good time and it's a great time of the cycle to do it. But remember that property development is often a 2-year project. So you don't want to be too fussed about timing it right, because if you ended up at the wrong time of the cycle, you could find you can't trade, you can't sell. So my suggestion is buy, renovate, refurbish, and redo it again, a brewer strategy for renovations. And for development, similarly, buy, get your development approval, pull down the old property, build something that you want to keep in the long term. And in fact, townhouses are becoming more the preferred style of accommodation for more and more people. And we know the government's got a plan of building 1.2 million dwellings. No, it's not going to happen as well. But we're going to have more medium density dwellings in our capital cities. We're going to live more that way. And so therefore owning a townhouse is a great investment for rental and for capital growth in the long term. But it's not as simple as you think, and there's lots of tricks and traps and costs involved. So get some suggestions and some advice. And again, I'd love our team to be able to help you. So go to metropole.com.au and just even have a look at the project development tab where you can see some of the things that we're doing and how it can help you. So Rob, good question. Thank you. There are lots of things to think about. And Ken, I'm not sure that with all due respect, the average accountant could answer those.
That's right, because for 2 reasons. It's not in their day-to-day field. They're doing more compliance work. This topic has law, it's got tax, it's got understanding property, and therefore you need to go to can I call it a property specialist that understands the tax, the legal implications, the different agreements that you've got to put in place, and obviously the types of structures that will benefit you.
Now, the next question actually is about joint venture. Thank you, because I actually remember this because I actually ended up having a chat with Vanessa about this personally. But she said, I'm looking at getting into property investment, not development, as a joint venture. And she was planning to do it with her brother so that they couldn't individually afford an investment grade property, but they thought they could do it jointly, Ken. And they said none of them own a property at the moment. Neither of us are married. And what she was hoping to do is buy a property, add value through renovations, or in fact, she said development, and then on-sell it to make a profit, so they're eventually going to be able to buy their own homes individually. And she was basically asking, is there anything she should watch out for, and what are some of the tax benefits, but also the implications of entering into a joint venture. So she and her brother were on the same page, but when I had a quick chat with her, there was lots of things she hadn't considered, Ken.
Yep, and look, we've used words like renovate, improve, develop, and we sort of throw them out there, but each one of those words has got a completely different tax implication. And that's because property can be taxed in one of 2 different ways for GST. So a typical property that you buy that's already existing, if you renovate it and with the intention to sell, then it's what they call input taxed, and you don't have to apply GST on the sale price, but you can't collect the GST credits that you've paid on the goods and services. If, however, you are substantially altering the old property so that the new one really bears no resemblance to the old one, or you're knocking down and rebuilding, in those 2 situations, you have a new residential property. And then when you sell it, then you pay GST. And you can claim the GST input credits on the materials and supplies that you've bought. So it's critical to understand not only how far that renovation development is going to take, and is it going to make it a new property? And you've got to investigate that. And then make sure you understand the GST components. So
when we had a quick chat with Vanessa, she didn't understand even the finance implications, because together they would have more borrowing capacity than 2 single people, but she didn't understand the concept of joint and severally liable.
And that's critical because what that means is each borrower is responsible for 100% of the debt. So if there's two of you, then you're responsible for 100% of the debt each, but each of you only have the value of 50% of the asset. So that really puts a brake on any other stuff you might be doing in the interim. Because when the bank looks at your assets and your liabilities, you owe $100, but you've only got a $50 asset.
Yes.
So it makes it much harder.
It also stops your borrowing capacity for other things, doesn't it?
Correct. And that's because the value of your debt is much higher than the value of the asset that you can align yourself with. Now, I always again go to structures when people are going to be working together, because different people have got different tax obligations, they've got different family situations, different risks. So for me, it's using a structure that allows each party to categorically say, I own X percent, and let's call it 50-50. And that means you can get your 50% of the profits, the rents, et cetera. But the important thing is our plans normally aren't always exactly what we put in place. And I've seen too many examples where people build something with the expectation to sell, but then they work out 2 years later, oh no, this is a great investment, I want to keep it. But one of the people wants to sell. So if you're in a structure, then it makes it much cheaper and easier, particularly with stamp duty, to buy out somebody. So you've got to look at structures because that will well and truly save you later on. And if you're doing a development where you'll have, say, 2 properties, like you were saying, and someone wants the left one, someone wants the right one, each one at the end will have both names. And as much as we might love our brother or sister or friend, there eventually comes a time when it's, let's call it quits. And then you've got to pay tax, GST, and stamp duty. So look at implementing what I call a co-development agreement, which basically says, let's build this. I'll get the left one, you get the right one. And then we can split the title so that each party owns theirs 100%. And that co-development agreement, when correctly implemented, means you don't pay the tax, you don't pay the GST, and you normally don't have to pay stamp duty. Some states you do because stamp duty is state-based, but depending on the state, you either pay no stamp duty or it helps you minimise the stamp duty.
I think another agreement you've really got to have is a joint venture agreement, Ken, which is different to this, makes a huge difference. And I know it's helped a lot of our clients, this agreement that you've over the years honed and fine-tuned, because the various state taxes, and it is a state tax in many ways we're talking about, keeps getting changed as well. So I know it's an agreement that we've been using for clients for a long time, but you've improved. But the joint venture agreement is, what happens if there isn't enough money in the kitty? What happens if you lose your job? Who's going to pay? Who's going to pay what costs? What are my responsibilities? What are your responsibilities? You start off with your brother or your friend with all the best intentions, but life gets in the way, doesn't it?
That's right. So as you said, you've got to identify roles and responsibilities. You've got to identify agreeable outcomes. So what are we going to sell at? When's the timing? Do we discount it if we can't sell it after 6 months? What happens if I can't continue funding a project? Can I be bought out? So you've got to have an exit strategy. And that's different to the co-development agreement. But that JV agreement can save a lot of heartache, particularly if one party can't complete.
Unfortunately, that happens at times. Somebody gets pregnant or somebody loses their job or gets divorced or gets married. And then all of a sudden there's another party involved in it as well. So, Vanessa, yes, is it worth getting involved in? Because if you can't get in the market on your own, should you do it with your brother or, in this case, a friend? So sometimes, yes. All we're saying is be careful and set it up right and get the advice again before you buy it. Because, again, as you said, Ken, you've got to be careful in what name you purchase it. And if you're going to do it in structures, then you've got to get your finance in the right entity as well, don't you?
Correct. It's not a closed loop, so to speak. You've got to identify what the best structure is. and then link it into your finance strategy. So your buying structure meets your finance requirements. And at the end of the day, finance is the name of the game. So if there's an issue with getting as much money as you would like, we might have to tweak the structure to allow you to still get the borrowed funds. And the other reason a structure can work very good is if you're buying to sell, because we get a lot of clients, Michael, that if you like, buy to sell, and they do this a couple of times so they can generate a pool of funds to then allow them to keep.
Yep.
So they're reinvesting those profits. So the first conversation I have with clients is, do you want to pay 47 cents tax on those profits, or would you rather pay 25 cents and therefore have more money to reinvest? And again, the ownership structure will determine that tax rate, which can actually give you twice as much money after tax to reinvest.
Well, I guess one of the things our listeners should be gleaning from this is if you're interested in getting yourself set up right, and it's not just for these more complicated ideas that our two questioners have handled, but also just for your first investment, which is going to be a long-lasting one, maybe it's worth seeing somebody like Ken Race. And while you are an accountant, we're not giving advice here. I think we've got to be careful and say that this is just general chat and information for these people. So Vanessa and Rob, don't go off and do anything that we've just spoken about or anyone else either. Get some advice. And while many normal accountants will be able to help you with some of these things, I think what you're doing, Ken, is putting your years of experience with real estate, property, law, finance, tax, and putting it all together for people. And it's interestingly one of the reasons why I was very impressed with the latest updated edition of What Every Property Investor Needs to Know About Finance, Tax and the Law, because you've brought together a lot of these disciplines in the one book. I don't think there's another Australian book that's got anything like this. And sure, there's stuff on the internet, but this is actually coming from somebody who's done it and advised lots of people rather than theory, Ken.
Yeah, and if you like, can I say the top end of town, if I can be a little bit crude or rude, the top end of town?
I think that's a fair assumption.
They've got access to very expensive law firms and accounting firms, and they get 4 or 5 people together in the one room, and strategies and solutions get developed. So what we've been able to do over many, many decades is understand those strategies and options, proceduralize them, and work with high-quality accountants, lawyers, tax specialists, so that these strategies are now available, can I say, to more middle Australia, to more normal people. So that's why
you're going to get in trouble saying normal people, Ken. But I know what you're getting at, that what we're doing is allowing the average Australian investor access to the sort of information that's been privileged only because of cost up to now.
It's been cost, yeah. And a lot of those firms actually won't even contemplate a meeting with you. I remember, can I say, I was looking for a tax lawyer about 25 years ago, and I found one that I thought was going to be very good. They wouldn't even contemplate talking to me to see if for me to become a client. It was like I wasn't on their top 100 people in Australia, so don't even bother. And they're the barriers that we've helped break.
Yeah, so that's Metropole Wealth Advisory, and you put a lot of the information in What Every Property Investor Needs to Know About Finance, Tax and the Law, and I'll leave a link to that great book in the show notes. Ken, another question from Phil, who lives on the Gold Coast by the looks of things, says, I'm considering setting up a self-managed super fund, not just for retirement savings, but also for asset protection and tax planning. Is this a smart idea, and what do I need to consider? Now, Phil, thank you for sending in the question, and I almost didn't submit this to Ken because he's not going to answer your question. He's not allowed to answer your question. We are not allowed to give you advice if it's a smart idea for you. So, Ken, can we maybe just look at what people's, not Phil's, options are, and is it a good idea for some people? And then, Phil, you're going to have to get individual advice because we're not going to get ourselves into trouble, or you. It would be wrong to give you advice without knowing a lot more about you, Phil.
Absolutely, Michael. So just to reiterate, this is general advice, not specific. So don't go out and act on it, either yourself, Phil, or someone in the audience. Now, superannuation, and in particular self-managed super funds, is under the spotlight. And there's this...
By the tax department.
By the tax department, by the federal government, by a lot of the super funds, the bigger ones that are controlled by APRA. And one of the big issues at the moment is, what is the purpose of super? And can I say quite simply, it's what they call the sole purpose test. The sole purpose test is it's there to generate retirement income for you or death benefits on your death. So they're the primary reasons, as opposed to I'm doing it for tax or I'm doing it for asset protection. Now, you get those benefits anyway, but as secondary benefits. So I think when someone's looking at a self-managed super fund, it's because they want either control over the investments they make, or they're looking at costs. Because when you go to an accountant, they charge you their cost based on time to prepare all the admin and the tax returns, whereas when you're in a larger fund, they charge you a percentage. So balance that together. The other thing, of course, is superannuation is not your money. That's a very hard concept for people to think. It is not your money. So therefore, you can't just go and tap into it and take it out. And especially if it's a self-managed super fund, you think you've got access to the bank account. Well, if you just take the money out, then, the tax man will get very, very upset with you. So you're locking up your money over a long period of time. And can I say, essentially, it's till retirement for most people. So there's conditions of release, which is predominantly on retirement. So for a lot of people, that choice of what can I buy is paramount for them. They want control. So clients who want to buy property, then we've got to look at other aspects. The legislation is very specific of what you can buy or can't buy in your super fund. You can't buy a residential property off yourself. So your super fund can't buy a property that you own in a trust or in your name or in your spouse's name. And the other thing is it can't develop. So some of the previous questions were about developing. You can't develop in your super fund unless you've got 100% of the cash. Now, there are some ways around that.
Can't borrow to develop is basically the strategy.
You can't borrow. So there are some exceptions to those rules, and we're working with a client at the moment who wants to develop a property they've had for a long time. Luckily, they bought it through their super in the right way that gives them those options that they can. But in normal circumstances, you can't. The other issue, particularly when you've got large lumpy assets, and this is an error I see time and time again, and it's actually, it brings a tear to my eye, that a typical self-managed super fund has got a husband and wife, a partner and another partner, or, a parent and a sibling. So limited numbers of people. And the problem when you buy a lumpy asset, if you've got a property in there, what happens when someone dies? And in the majority of cases, you've got to sell that property and you've got to sell it and get the money and pay it out within 90 days. Now, there are strategies you can put in place that allows you not to have that problem. But again, it's asking the right questions, or more importantly, going to the right people who know the right questions. So understand what happens on the death of a partner, because I was only talking to somebody within the last couple of days who thought there was this automatic right that the assets of the deceased spouse go to the surviving spouse. And I said, no. Those assets are going to have to be sold. The money's going to have to come out, and then the surviving spouse can't get the money in. So lots of issues that you've got to address. Many people make avoidable errors that costs certainly many tens of thousands of dollars, but for the majority, it's hundreds of thousands of dollars. So get the right advice.
So, Ken, I know one of the things you did when you checked Pam and my super fund was you saw that even though it had been updated a number of times over the years, it was very much out of date. So when you do a super fund review, what you and the team at Metropole Wealth Advisory do is sometimes suggest, well, remember, super fund is just a trust deed in many ways, isn't it, with a corporate trustee? So either adding some things to it or changing the super fund. And I know that for some clients, you actually organise a will in their super funds. And people say, I've already got a will. But you've already mentioned, Ken, that the money in your super fund is not yours. So the will won't cover it. So there's a number of things. So I know it's a special service. The team at Metropole Wealth Advisory do a self-managed super fund review. So if you're considering getting involved, remember, part of our licensing is we have a financial planning arm and financial planning affiliates. So therefore, that needs proper financial planning advice. And similarly with a super fund review, we can definitely help you with that. So go to Metropole and click on the Wealth Advisory tab, or I'll leave a link in the show notes. Now, Ken, there's one more question that I'm very aware of, and I became aware of this concept many years ago, but a lot of people haven't even heard about it. And Wilson's question, Wilson from Richmond, Victoria, asked, I've heard about people using a bucket company to minimise tax. What is it and how can I benefit using one? Now, again, we're not giving you specific advice, Wilson, but thank you for the question.
Yeah, great question, Wilson. Let me premise the answer that that's a strategy normally only available to people in business and a business that's correctly set up in the right structure. Because if you earn income directly, call it a wage, you get your dividend distributions, you get your rent in your name, interest income in your name, then the money comes to you, it's automatically taxed there and then. What a bucket company is, it's a company that sits on the side that can receive, can I say, discretionary distributions. So money that hasn't already been taxed per se, so it didn't go into the hands of somebody first. So that's why I said it's normally through a business. If people are operating their business through a trust, or if people are going through a company with a trust as a shareholder, it can then flow to this bucket company. What the bucket company does is it taxes that money at the company tax rate. And the company tax rate is 25%. But it could be as high as 30 depending on which money you're sending. So what it does is it actually saves you that top-up tax initially instead of you getting the money and then putting the money in the bank. So can I say it kicks the can down the road a little bit? Because when the funds are finally distributed from that bucket company, then the receiver pays the tax at their marginal tax rate, less any franking credits. And franking credits is the term used to refer to the tax that the company has already paid. So if the company's already paid 25 cents, if your tax rate when you receive the money is 47, then you only pay the extra 22 cents. But you might be kicking the can down the road. So for some people, it's very good to smooth out income. It's good to save until you eventually need it. What you've got to be careful, though, is the source of that money. And people who generate that money through their own personal exertion, I'm a consultant, I've only got one client, they can lose a lot of the benefits flowing through. But can I say the most critical thing to do is that bucket company shareholder must be a discretionary trust. It cannot be an individual. The ATO has actually identified problems if the shareholder is an individual. So for once, the ATO has sort of let us look inside its mind and identify that if you're going to have a bucket company, use a shareholder such as a discretionary trust.
In summary, if I get it right, what a bucket company does is it allows you to cap or minimise the tax that you may distribute to a person. So if your business is operating a company or trust structure, or even if it's an investment trust that's got lots of income flowing to it, it has to distribute it. And if it distributes to the shareholders or to the beneficiaries, often it's sometimes up to 47 cents in the dollar. So here you're actually distributing it to a company that pays a lower tax rate. And then the company's got a number of options what it does with it. It could invest in shares, could even invest in property. I don't think it should ever be involved in business or other things. That's a different thing altogether. But it's a structure that would suit some people, but not the average PAYG earner.
That's right. Because the other thing, of course, is assets owned in a company, when they're sold, they lose the 50% capital gains tax discount. So you've got to balance all those things and talk to somebody who understands and can help guide you with the options and the different benefits and disadvantages.
Okay, can I throw one out? Then my bucket company's got $100,000 in it. Could it loan the funds to another entity, all done correctly and documented correctly?
Yep. So many, many years ago, that was very common, because then people used the benefit of those funds having only paid, in those days, the 30 cents tax. Now what the ATO says is, I'm going to treat it as if it's a dividend, and we're going to tax you accordingly, unless you put a loan agreement in place. You have to have a formal loan agreement, which requires you to pay back the interest and the principal at the ATO designated rates. But for a lot of people, that is still beneficial, because if you've got to pay the loan back over, call it 20 years, again, you're postponing your tax over a 20-year period instead of paying it instantly.
And you've got access to the funds, and you can do something more useful with them, like leverage. So again, this requires specific advice. And so, Wilson, thank you for the question, but it's really something that you need to get specific advice on for your situation. It's not something anyone or everyone could use. Ken, I'm going to throw another question at you, and that is, you spent a lot of time and effort updating, revising chapters in what every property investor needs to know about finance, tax, and the law. What's the biggest difference or change? What's the biggest thing that people should be aware of at the moment?
Very good question, and thank you for asking it, Michael. I think it's in a couple of areas. The first one is the use of trusts or structures. We've found that a lot of accountants are frightened off by recommending those structures to their clients. Can I say, with all due respect, because they don't properly understand it. And when the ATO says negative things about it, it's easier not to use something. But the ATO has never said you can't use it. It's, you've got to use these things correctly. And therefore, go to somebody who understands them and who's actually spoken to the ATO, because I certainly have, about the proper use of these structures and when they can work to somebody's benefit.
Well, recently I had on this podcast Tim Lowe, the Assistant Commissioner of Taxation. They're very comfortable with it as long as they're used for the right reasons. But interestingly, there's a few people out there in the podcast world who suggest the only reason people have trust is because accountants talk them into it, because it makes the accountants more money and annual compliance costs. Now, if your accountant is doing it for that reason, no, you shouldn't be doing it. And if you're doing it just for tax benefits, again, that's not the right reason. And I know in what every property investor needs to know about finance, tax, and the law, you've gone into the various natures of trust, the various sorts, because there's lots of different sorts, and when the right time could be to use them. But Ken, in all our wealthy clients and the high net worth clients at Metropole, they don't own things in their own name. They own them in structures, trusts being one of them. There's a number of different sorts of structures, but there's nothing new about that, is there? Why try and reinvent it or do things differently? So I'm surprised that some people poo-pah the use of trusts.
And look, I think it goes back to initial education. And if you use me as an example, when I went through and did my accounting degree, we would have spent 5 minutes on trusts, whereas we would have spent a week on companies. So when practitioners come out into the world, so to speak, it's not something that they're familiar with. And when you read the headlines, you know, ATO is going to attack trusts or this or that, people get scared. But as you said, the correct use of them in the proper context can have major benefits to people. It's just using them correctly.
So in what every property investor needs to know about finance, tax and law, there's a little bit about property. There's a lot about finance because the world of finance has changed. And as you said just earlier in our conversation, property investment's a game of finance with some dwellings thrown in the middle. There's a significant section on tax and structuring, how to legally minimize your tax. And then in the legal section, I know you spent a lot of time writing about estate planning and wills and protecting your assets. What's the benefit of actually building them all and then letting the wrong people get access to them, Ken?
Correct. I think more and more people are very cautious now about moving assets to the next generation when that next generation could include a divorced child and then the wrong person gets it. Or one of the children maybe is, can I call them almost a black sheep of the family? So how do they get benefit, living money while protecting their capital? So the traditional will really doesn't help the majority of people. And that's the other big change I've seen, that people now are a lot more thoughtful about creating a robust estate plan, not just a will, because an estate plan includes many other aspects, not just the will. And they take all those things into account. And you've got to be careful, as I'm a parent. We don't want to rule from the grave, but I like the term guide from the grave. And as such, educate your children, I think, along the way, so that they don't get your money and then say, oh, good, I'm going to throw a party. They've understood how hard it was to make. So understand estate planning. And I think the traditional will, which is when I die, it goes to my spouse, and when they die, it goes to the children, for the majority of people now just doesn't cut it.
Well, I know there's another section in the book that you've written about how to pass it on to people, to your family, to your kids, to your relatives before you die. So giving with a warm hand rather than the cold hand. Lots of great information in what every property investor needs to know about finance, tax and the law. I'll leave a link in the show notes. Thank you for answering those questions, Ken. Look forward to catching up, and maybe next time we'll do another question and answer session, because if you've got some questions, leave them in any of our social media platforms or on Property Update, and we'll get Ken to help you with those. Thanks for your time, Ken.
Thank you, Michael.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I want to ask you a question. If you only had one day left in your life, what would you want to do the most? Now, too many people live a life according to a script that they didn't even write, only to discover the punchline too late. I wish I had the courage to be my true self is one of the biggest regrets a lot of people have when they're dying, apparently. Other big regrets they have is, I wish I never worked so hard. Or they say things like, I wish I had the courage to express my feelings. Or I wish I'd let myself be happier. Or I wish I'd stayed in touch with my friends. You see, often we're trapped working on other people's to-do lists so that we never stop to connect with our soul and ask, what is it that we can't wait to do? Chasing dreams, sure, it can feel intimidating, but nothing's as dreadful as living a life of regret. Now, I see people all the time sacrificing their health for wealth. Then they spend their wealth trying to regain their health. So from now on, stop keeping score of the digits in your bank account and start chasing invaluable experiences. Start making an impact. You're the author. You're the director. You're the hero of your story. At any moment, you've got the power to reprioritize it and reinvent yourself. So it's never too late. In fact, you'll never have more time than you do right now. So my recommendation in this mindset message is to live every day like it could be your last, because one day you'll be right. If today was your final day, what would you most want to do? Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?